Hello, everyone, and welcome back. Look, if you've ever stared at a pile of financial documents and just felt totally overwhelmed by tax slabs or, figuring out which tax regime to actually pick, then this explainer is exactly what you need. Taxes can be super confusing, right? The jargon alone is enough to give anyone a headache. But today, we're going to change that. In the next 5 minutes, I'm going to break down the basic income tax rules in India for the financial year 2026 to 27 in the simplest way possible. No jargon, just clear, actionable info.
Okay, let's dive into this. Here's our quick roadmap for today. 1. Income tax basics. 2. Sources of taxable income. 3. Choosing your tax regime. 4. Key tax deductions explained. 5. Filing your tax return. And 6. Final tax takeaways.
All right, starting right off with Section 1, Income Tax Basics Explained.
So I want to ask you this fundamental question right out of the gate. Who actually has to pay income tax? It sounds like a no-brainer, but the answer actually surprises a lot of people who think it only applies to, say, your traditional corporate office worker.
Simply put, income tax is a tax paid to the government of India on the income you earn. It's basically a direct contribution based on the money hitting your bank accounts over the course of the financial year. But, income is a pretty broad term, which means we really need to get specific about exactly where that money is coming from.
That brings us to Section 2, Sources of Taxable Income.
You might have to pay income tax if you earn money from any of these 5 primary sources. So we've got your everyday salary as an employee or profits from a business or profession. It also covers income from house property, like rent you might collect, and capital gains, which are the profits from selling assets like shares or real estate. And finally, other sources, which just captures everyday things like bank interest or dividends. Basically, if money is flowing to you through any of these channels, the government considers it income. Now, here is a massive point of confusion. Even if your tax liability is literally zero, you may still need to file an income tax return. So many people think, hey, I don't owe any tax this year, so I get to skip the paperwork. No way, that is totally incorrect. Owing zero money doesn't automatically mean zero paperwork. You absolutely have to check if you meet the basic conditions that require a return to be filed. Moving right along to Section 3, Choosing Your Tax Regime. Currently, the government offers you 2 different tracks. The new tax regime offers lower tax rates, but the catch is, it allows very few deductions and exemptions. Keep in mind, this is actually the default option for most taxpayers now, meaning if you don't actively choose otherwise, this is the bucket you'll be placed in. It's usually the simpler route. On the flip side, the old tax regime has higher tax rates, but it allows for all those classic deductions, like Section 80C, 80D, home loan interest, and HRA. So if you're someone who claims a ton of deductions, the old regime might be way better for you. If not, stick with the new one. Let's dig into that a bit more with Section 4, Key Tax Deductions Explained. So, if you are leaning towards the old regime, you really need to know the tools available to lower your tax burden. Section 80C is your heavy hitter here, covering major investments like PPF, EPF, ELSS, and life insurance. Then there's Section 80D, which is dedicated to your health insurance premiums. You can also claim deductions on your home loan interest, which is a massive relief for property owners. And finally, Section 80G covers your charitable donations. Understanding these categories is absolutely crucial to maximizing your benefits under the old system. But wait, just knowing the rules isn't quite enough. You must always keep your supporting documents for these deductions safe and sound. If you claim an investment or a health premium, you need the actual paperwork to prove it. Seriously, organization here is just as important as the investment itself.
Okay, on to Section 5, Filing Your Tax Return.
Filing your income tax return is super important, and it goes way beyond just, ticking a box for the government. It helps you claim tax refunds if you've paid more than you actually owe. Plus, it's incredibly useful when applying for loans and visas. Honestly, banks and embassies rely heavily on these documents. It also serves as undeniable proof of your income. And, of course, filing on time helps you avoid totally unnecessary penalties for non-compliance. It's really just a protective measure for your whole financial life.
So how do we get this done efficiently? Well, here are the essential steps you need to take. First, collect Form 16 from your employer. This outlines the tax they've already deducted. Next, check your Annual Information Statement, or AIS, to make sure all your financial transactions are accurately reflected there. Then, double-check your bank details so any refunds actually go to the right place. Finally, submit and, this is huge, e-verify your return. If you don't e-verify, the process isn't even considered complete.
Wrapping up with Section 6 Final Tax Takeaways.
Here is your clear 5-minute action plan for FY 2026-27. Make sure you know exactly what your sources of income are. Carefully choose the right tax regime by comparing the new default against the old system. If you do go with the old regime, claim those eligible deductions. Most importantly, file your return before the due date and keep all your financial records securely locked away. I'm going to leave you with this final provocative thought. By not optimizing your regime choice, by missing out on deductions, or just failing to file and claim your refund, are you letting the government keep money that legally belongs to you? Smart, timely tax planning is entirely in your hands. Thank you so much for joining me for this explainer. If you found this helpful, be sure to like, share, and subscribe. Keep optimizing, and I'll catch you next time.